Wonderful. All right, so we are on, and this webinar would be about the art of candle patterns and Fibonacci trading. Wonderful subject by itself, especially as it's coming with some strategy I'll share you here, guys. I expect it to be very, very exciting, so I hope you are excited as well. So who am I? I'm Vladimir Ribakov. I'm 35 years old. My experience in the trading world is a bit more than 13 years of trading all kind of markets, not only Forex. I am a former dealer in a broker house, and I'm a former private capital hedge fund trader. Since about 6 years, 7 years, I'm full-time retail, which means my own, completely own money, Forex trader and mentor. I'm the owner of VladimirRibakov.com and TradersAcademyClub.com. Besides that, I'm developing tools, trading tools for my followers. Among the most favorite ones and the most popular ones, you would find Divergence University Trading Course, SRS, Triple B, and Crystal Ball. This is my blog where you can follow my work on daily basis, VladimirRibakov.com. You would find here a lot of great information, articles, trading ideas every single day, and so on. That's my YouTube channel where you can find a lot of videos and educational materials. And Trading Club, as mentioned before, here I hold my live trading rooms on daily basis. Divergence University, full trading course, SRS Trend Rider, a trading system to ride trends, Triple B, and Crystal Balls. Crystal Ball is a statistical based trading system. In today's menu, and this is what I'll be sharing today, Fibonacci numbers, clearance zone, a critical subject traders have to understand and learn how to deal with it properly. I will talk about that, what happens around these areas. We will talk about candle patterns, and the most important thing is the combo Fibonacci with candle patterns. Of course, we will talk about a lot of examples, how to work with it correctly, and how to enjoy this strategy, its advantages in your trading. Okay, Conrad, I will send the recording to CM Trading, and also we'll publish that in among my community, so hopefully it will be helpful for you. All right, so let's start, guys. And once again, if you will have, guys, any questions, just write it down in the chat. Okay, give me some time. I will reach the question and I'll answer. Okay, so I'll go step by step, subject by subject. We'll cover that from all the angles, and we'll answer all the questions later on. I'm sorry for my voice. I'm a bit cold since yesterday, so if I sound a bit weird, sorry for that. Let's begin. Who is Fibonacci? Leonardo Bonacci, or Leonardo of Pisa, later known as Fibonacci, was an Italian mathematician who, opposed to what many may think, is not the inventor of the Fibonacci sequence. He was the one that introduced it to the Western world. In his book, Le Barbacci, the Book of Calculation, in 1202. Just imagine how a long time ago it all was, right? It all happened. Now, the Fibonacci sequence is a series of numbers which describe in perfect proportions basically anything in the universe. And I mean anything. It's pretty cool if you think about it. Okay, now the idea of the sequence derives by adding last two numbers together. So how does it work 1 and 1 gives us 2. 1 and 2 gives us 3. 2 and 3 gives us 5. 3 and 5, 8. 5, 8 give us 13. 8 and 13 give us 21, and so on. Okay? So that's basically how it looks like. So when we sum it up together, the two numbers, the following number will be the sum of it. But it doesn't look so exciting and it stops here, right? Here comes the magic. Every single following numbers you would take and divide each other will give you this amazing ratio, which brings us towards the 0.618, because it's 7 with some following here, right? Of the Fibonacci level, the levels we as traders love to use. And where come the other numbers from? For example, the 0.38, we take a number and we divide it not by the following number, but the second following number. So there is 21, 34, 55. So we divide 21 and 55, right? And this is the number we get. We divide 34 and the second following number, 89, and that's what we get. So the ratios in between the numbers are amazing, and that's why they represent so much value in everything in life generally, but in trading mainly. The ratio between numbers, it doesn't matter how big the move is or how well it's structured or how great the waves is broken down to, the numbers would be there respectfully. There are several ways to use the Fibonacci numbers. The two main ones in the technical analysis are the following: Fibonacci retracements, Fibonacci expansions. Today, I will reveal the strategy that is based on Fibonacci retracement levels coming together with candlestick patterns and clearance zones. Okay, so the first step in working with Fibonacci is defining the highs and the lows correctly. What do I mean by that? One of the issues traders always have is define correctly, swing highs and swing lows, and refer the move properly. For example, in this move from here to here, that might look like a high, that might look like a low, that might look like another high, that might look like another low. And they would be wrong because they would not define properly a swing high or low. Now, instead of going very, very deep into the technical analysis, there are different ways to work with that. Some traders love the indicator zigzag, for example. I don't like that because it's repainting as the high and the low is created. So from my point of view, the zigzag is not reliable enough. It is reliable when you are looking backwards. It's not really reliable and useful when you are working live at present. So there are fractals, which tend to be way too more sensitive. There are different other indicators, and there's one way that I love to work with. And this way is to apply two moving averages and work with them. How do we work with moving averages? So what I take is the levels before the moving average cross each other, right? So what kind of moving average we will use? Any two moving averages with ratio of 2 in between them. So 2 and 4, 3 and 6, 4 and 8, 5, 10, 10, 20, 20, 40, and so on. Okay, you got the idea. The bigger the moving average you would work, the bigger the trends you would refer to. The smaller the moving average will be, the more sensitive the changes would be. So depends on the length and period of a trend you want to work with, adjust the moving averages accordingly. What are we looking for when we work with the moving averages? Crosses. When we cross from up to up, the red one, right? The more sensitive one, the shorter moving average, when it crosses the blue line up, we are looking at the last low before the cross, which was here. Then we can see the cross down right here. We are looking at the last top before the cross, which was here. Then cross up again. We are looking on the last low before the cross, which is here. Cross down again, looking at the last top before the cross, which was right here. Now the moving average, once they cross, of course, at the close of the candle, not during a live candle, right? And then your highs and lows are official. And you can see on the example I was talking about before, when we take a look on this movement, some traders might confuse and say this is a low, this is a high, this is a high, this is a low, which would be wrong. And by the moving average, you can see there was only one cross from bottom to the up. So this is the low and this is the top because after that it crossed downwards. Okay, so the moving averages would help you identify clearly good swing highs and lows. Of course, it's only one of the options. Once you define the highs and the lows properly, what you do next is you measure Fibonacci from starting point to ending point, from low to high or from high to low. Depends what are you looking to trade. If you are in a bullish trend and you are looking for retraces and buy, for example, then you are measuring the Fibonacci from low to high. If you are in a downtrend, vice versa. Okay, so this is the next step we do. Then we get Fibonacci levels right here, the magical numbers, okay, of the Fibonacci. Of course, these are the main three we would want to use. The healthiest retraces happen back to this area. Some of them would be as deep as to 76.4, not so common, and even less common, they will be blocked by 23.6. All the levels are acceptable. This trio is the most popular and I would say even powerful to use. Okay, so once we did that, we chose the low to the high. We always go from starting point to the ending point. We draw the Fibonacci, we get the numbers. The next step we want to do is we take this movement from along low to high, and we want to make sure this is a trending movement. Let me explain. Bullish trend is defined when there is a series of higher highs and higher lows, at least triple, higher highs, higher lows. This is a definition for a bullish trend. A bearish trend would be the one that will present you triple lower highs and lower lows. So far so good, at least triple. So when we are checking from low to high, this movement must be a trend, and that could be verified on the current time frame or one lower time frame. In other words, if this is a daily time frame, I can drop down to 4-hour chart, the next following time frame, and verify that the move I am measuring from low to high would provide me this structure triple higher highs, triple higher lows at least. If I can verify I have this trending condition there, perfecto, I can work with that. And this could be defined as a move to work with. Okay? So this is how we identify swing points, how we measure a movement, and how do we verify it to be a trend. There are a couple of things you need to understand though. You want to avoid one-shot moves. What does that mean? Some moves are going fast from top to bottom or bottom to top. How fast? If you will go to lower time frame, you would never be able, you see, it's straight movement. You would never be able to break it into triple lower highs, triple lower lows. It's straight move. Because of that, it's a one-shot move. We do not want to rely on one-shot move. They are much harder to work with. Many of them are random. Many of them are news related. Many of them are pure noise, speculative noise on the very current day. Okay, so you definitely don't want to work with that. All right, so that's as per the Fibonacci, as for now. The next step we have, that's the candlesticks. There are a lot, tens of candlestick patterns. They all are usable. My favorite is this, the engulfing, and that's why I would focus mainly, not only, but mainly on the engulfing. It has much more value than the others when it comes with clearing zones, which I will be presenting in a minute. Okay, so let's talk about the patterns. We have engulfing, we have hammers, inverted hammers, which basically look the same, just reversed, bullish and bearish haramis, vice versa to the engulfings, piercing piercing line and dark cloud cover and kickers. That's the most common patterns when it comes to work with this strategy. As I mentioned before, I prefer mainly the engulfing. So I'll be explaining the engulfing in a minute a bit deeper. I do want to give a bit of the other patterns for you to understand. So the hammer pattern looks like that. Small body, big spike, and represents momentum change. How does that happen? If it was a downtrend before and the price opened right here, during this time, which could be a day, a 4 hour, a week, or whatever it is, right? The buyers and the sellers had the fight. The sellers tried to push it lower, the buyers tried to push it higher. But at the end of the day, the fact is the following. The sellers took it as low as to this level right here to continue this downtrend, and from this low the control goes to the buyers. And how do we know that? They pushed all the way up where the close is above the open. So the momentum change happens within this candle. When the hammer is at the end of an up move, it's called a hanging man. The psychology here is slightly different. That's called positions closed. At the end of the rally, the buyers, for whatever the reason is, start to cash out their positions. The price drops lower. right? Some of the buyers, those who were late to enjoy the trend, they still jump in because the price goes a bit lower, but the main forces, the big money traders, they understand that this is the place to give it up and the price drops. Inverted hammer would be the exact same thing, just opposite to the hammers. That's pretty much it. Claudia, as I said before, this webinar is recorded and would be shared later by myself to my followers or by CM Trading to their followers. The Harami candle pattern is a fully inner candle pattern inside a bigger previous candle. So at the end of move down, there is a big red candle and the next following candle slowing down the momentum and creating lower body. Now the most important thing for the Haramis to pay attention to is body inside the body, the previous candle body, ideally with a gap, not always it's like that, and the spikes are inside the bigger candle spikes. So fully covered. Bearish Harami is the vice versa. At the end of an uptrend, there is a massive bullish candle and a bearish Harami, red body, which is inner to the green candle body, and the spikes that are inside the range of the green candle spikes. Okay, so basically reversed to the engulfing. And two very powerful patterns, a lot of that goes to the stocks market, but also relevant to Forex, is the gapping patterns. Piercing and the dark cloud cover, they are the same. The idea is at the end of a trend, we open with the gap to the direction of the trend. So the gap down, right, where the open price is below the previous candle close price, but the close of the green candle is within the range, within the body range of the red candle. So the gap down looks like a massive momentum to the downside, but the fact is that this candle closes within the range of the red candle, previous red candle. This is a great representation of the bulls being ready to take a control. And the dark cloud is the same, just reversed at the end of an uptrend. And the kickers is basically the same idea, just opposite gap. So if this was with the trend gap, this is the opposed ones. Okay, this was an uptrend and the gap is to the downside. Okay, and vice versa for the bullish one. So all these candles are wonderful. As I mentioned before, my favorite is the engulfing. The engulfing is formed by two candles. Engulfing could be bullish or bearish. The pattern is pretty easy to recognize structure. It consists of a candle or a bar which gets engulfed, swallowed, covered by the next candle on the chart. To get a valid engulfing pattern, the first candle should completely fit inside the body of the next candle. Note, and I want you to remember that, guys, the higher the time frames you would work, not just with engulfing, with all of the patterns, the more reliable it will be. 5-minute candles are come with much more noise, much less reliability, and they could work in times, of course, but that's not something you want to make a conclusion based on. Why? Very simple answer. during a daily candle pattern, for example, there is a money flow which equals much more than any flow of money that you can see on 5 minutes, 15 minutes, or 1 hour chart. It does not mean they will not work. They will. But they will come with much more noise. Why? Because there is much less money involved. If there is much less money involved in a movement, it is less reliable. That's the logic standing behind it. Now, engulfing could come in 2 ways: full engulfing or body engulfing. Full engulfing means like here, where body covers the body fully and the spikes cover the previous candle spikes as well. This is full, body to body, spikes to spike. This would be partial because only the body covers the previous body. The spikes did not cover. Okay? So this would be the partial, full, partial, full, and full. That's the candlesticks and what you have to know about it. Okay? Now, we discussed about measuring the moves, right? We discussed about verification on the lower time frame. Now let's talk about the clearance zone. Clearance zone refers to the area where the less experienced traders tend to place their protections. In other words, the stop losses. What are these levels normally? The most recent swing high or low, right? Because why? Because that's what they teach in the school, in a technical school or anywhere else. There is nothing wrong with that. But there is one thing you need to understand. These levels are well known to the big money, to the institutional traders. The orders, the protective orders, the pending orders, and so on, are well exposed, especially when they are in the real market. The big money knows to identify the non-experienced money behavior. It's very easy to clean specific levels and then move to the direction, the desired direction the traders have. Now, how many times you had with yourself the next experience? You are making your analysis, enter a position, your stop loss is taken, but then, boom, the market is moving to the direction you expected, but without you. How many times it happened for you? And it's common. It happened to everyone, and it will continue to happen to everyone if you will not pay attention to a very important fact. Clearance zone is the area where most stop losses are placed. How do we spot them? In the most recent trend line, most recent trend wave, the most recent highs and lows are the ones that you have to define. So if this is a move up, you are looking on the most recent lows, and you can see you had a low here and you had a low here. Once these areas are cleaned, and they are in complete majority of times when the moves are correct and structured. If the moves are not structured and there is no money involved, levels will not be respected. But if the move is real and there is money flow, that's where you will want to be, and that's how you recognize that. When the level is cleaned and the stop losses, the early stop losses of those who enter the buy before they should, when the stop losses are collected, there is much more free money in the market ready to be collected. So what happens in this situation is there are a lot of buyers at that area. Why? Because, well, it looks like a bullish trend and it looks massive, and now there is a bullish candle. Let's buy, right? That's what a lot of traders say to themselves. And this is totally wrong assumption. Just to buy because it looks like a buy doesn't make any sense. So the big guys take the advantage, push the price. The small traders start to say, damn it, right? Start to blame the world for the loss, and then the price goes to the direction they expected, just without them. So how do we spot these clearance areas? In the most recent trend you work with, mark the most recent lows if you are in an uptrend, most recent highs if you are in a downtrend. Let it be cleaned, and then what you would want to see is basically a turnaround. So clearance and close again above this area. This would be called a false breakout, a clearance, a fake breakout, or whatever you want, right, above the critical zone. This critical zone is a clearance zone. So cleaned, retraced, closed above. That's how we find our clearance zones, and we verify the clearance by break below, close above for an uptrend. Yeah? For downtrend it will be the vice versa. We will see examples soon. All right, so false breakout, fake breakout would basically verify the clearance. Now, you would still have to wait for your setup. You definitely want to see a candle pattern, one of the patterns we mentioned before, right? That's where you would want to see this pattern, at the clearance, at the fake breakout. That's where the value is, but you will have to validate your setup. What do I mean by that? Take a look on this example. We have here higher highs, higher lows for an uptrend. We drop all the way down to clear this area, right? This clearance zone. So we clean this area. We got this engulfing, right? But we never completed a false breakout. What is this false breakout? Basically, break down and close again above the clearance zone. It happened only on the next candle, right here. Right? So wait for the complete setup. Don't cheat. Get all the signs. Why? That's the verifications you would want to work with. This is also, by the way, called a verification candle. So here you spot engulfing, right? Or any other pattern, harami, kicker, piercing, cloud, hammers, and so on. The next candle is a verification candle, which basically closes above the close of the engulfing. That's two candles in the direction you want to trade. Great sign. And the next thing you do want to pay attention to before we go to examples is the risk reward plan. If your trade would have a bad risk reward, do not trade it. And an example for a bad risk reward you can find here, right? Move down, clearance zone, clearance zone. This one was cleaned, making here a dark cloud right here. Dark cloud candle pattern. this would be a very good risk reward for you, right? You would look for entries there, aiming at least to the previous low and aiming for at least 1 to 2 risk reward, ideally even more. But if you would work with this engulfing, for example, you would never be able to get a good risk reward here, right? No good risk reward, no trades, or looking for better entries. Okay, do not chase your trade. If it's not as good as it should be, wait for the next one. No one is forcing you to trade always beside yourself. It's only us, the traders, that believe that we always have to be in a trade, which is wrong. Okay, guys, excuse me for 20 seconds, please. Yeah, I'm sorry. As mentioned before, I'm a bit cold, so sorry for that. So the risk reward is very, very, very critical thing. Now, what is the risk reward for those who do not know? It's the ratio between what you are risking and what is the reward you expect. So if you are risking, for example, $100 for a position, you have to aim to take back 200 or more. This will allow you to keep your balance moving forward even when you would experience some losses, and you would. There is no such thing, no losses in trading. I hope you understand that. Okay, there is no such thing, holy grail, or no losses. It's impossible. Rather than chasing after something like that, the holy grail, you better learn to deal with a correct risk-reward ratio and respect that in your trading. So, I spoke enough. Now let's go to the chart and see some examples. So remember, that's the next steps. We define a trend by calling it from swing high to swing low. We verify the trend on the current or the lower time frame. We want to verify the trend by the idea of triple or more lower highs, lower lows in a downtrend. Okay, for uptrend it will be the vice versa, higher highs, higher lows. Then we are marking swing points where you could potentially have the stop loss zones. Once you receive a break of this area, we treat it as a clearance zone. Will that cause a retrace after that? We don't know. We cannot predict. And remember, we trade facts, not wishes, expectations, predictions, and so on. We trade the here and now. So we got a break, then we got an engulfing right at that moment. Beautiful engulfing. Voila. So we have an option to go and to make a position here. So we check, if I enter here, would I get a good risk reward to the bottom here? Most likely not. It's less than 1 to 2. So I either skip or looking for better opportunities after retraces or after the second attempt to break the same level. Here we get another breakout, another engulfing, and much better risk reward. Okay, next one. Again, define a trend, verify that triple higher highs, higher lows, define me an uptrend. We go down. Normally we go down to 38 to 61. Sometimes we go as deep as 76.4. We define the clearance zone 1 and 2. Now what did we have here? We got a fake breakout at that moment without any candle pattern. No clear candle pattern, no trading. We go down, we are clearing the next area, and we face here a piercing, and right after an engulfing. Both are totally great to trade. If you entered one and failed and got another opportunity, this is another trade. And what will make it worthwhile for you as a trader is the risk reward you would use. So let's assume that you would be trading this piercing, and here it would kick your stop loss because you would protect below the pattern. And right after that, it gives you another great engulfing. The risk reward you can receive here is massive. So you end up with one loss and you end up with much bigger profits. The advantages of risk reward trading in the direction of a trend. Uptrend, how do we know it's an uptrend? Higher highs, higher lows. Clearance zone belong to this area and this area. Now we clean here and we got, what pattern is that? Harami. Wonderful Harami, which provides us a good risk reward all the way up. Should we wait for anything else? We can work for verification candle. We can wait for verification candle. It's one candle that would close above the close of the Harami. So basically give us another candle in the same direction. It will be more conservative, but on the other side, it might harm the risk reward plan. Conservativeness comes with price sometimes. Aggressiveness too. Risk reward would be the very thing that will keep you positive even when there will be several bad trades. The idea of the risk reward is very, very important. If you think about it this way, in terms of plus and minuses, when you lose 1%, but you earn 2% or more in your rewards, you can allow yourself have more losses than winners. Think about it. 1% loss and only 2 winners. You still are in profit. And the further that goes in the table and the bigger the rewards would be here for you, the greater your statistics would be. So once again, let's take a look at an example for a downtrend. We first of all define a downtrend. How do we define a downtrend? Series of lower highs, lower lows. Okay, after that, clearance zones. We got a zone here, we got a zone here. You can also use this level, of course. Swing highs and lows. Once we get it cleared, like here, this is inverted hammer. representing a potential reversal. So we are in a downtrend. My clearance zone was cleaned. I got this beautiful hammer. I got also verification candle here with the close below the close, or even the low, if you want to be more conservative, of the hammer. And I get a very, very good risk reward trade. Do I need anything else here? No. Uptrend defined. How do we define an uptrend? Triple higher highs, triple higher lows. Next step, and remember, we can verify the trend on the current time frame or to go one lower time frame. Both are totally acceptable, but they have to have this structure, and it has to be clear. We define clearance zone, 1, 2. Cleaned, cleaned. Created a false breakout? Yes. Created a candle pattern? Yes. Is that in the Fibonacci levels? Very close to that. Very, very close to 38.2. Is that a valid engulfing? Yes. Is it a clear trend? Yes. Do I have a good risk reward here? Yes. Can I trade it? Yes. Okay, risk reward you measure from your entry to your protection to your target, which is at least the zone of the previous high of the entire move or low of the entire move. Okay, here we go. Uptrend. How do I know it's an uptrend? Several highs in the same direction. Clearance zone 1, clearance zone 2. I have several more on the go here in this trend. Beautiful pattern right here. Great. Harami. Did not work out. Failed. Everything looked perfect there. Further move down. Another pattern. Great engulfing. It's also called a morning star for all those of you who are into the candle patterns and know it a bit deeper. Checking. Clean the area? Yes. Is that a good uptrend? Yes. Respecting the clearance zone? Yes. Completing a false breakout? Yes. Candle pattern? Yes. Risk reward? Yes. One loss, one bigger profit. The game of the stats. One more example of the importance of the risk and reward. Downtrend, swing points for clearances, right? Clearance and clearance. Price went above? Yes. Closed as a pattern with a false breakout? Yeah. Is it a wonderful trade in terms of risk reward? Failed. Does that mean the strategy is terrible? Of course not. It means we're waiting for the next opportunity with which be correct. And the next opportunity comes right after with this massive engulfing. It did not make a false breakout after the engulfing. It did the false breakout after the verification candle right here. Same story. I got a good risk reward, at least 1 to 2. And I finish with one loss and one bigger profit. Part of the game. That will happen. Never, ever, ever expect only winners. Never. It's impossible. Never will happen, never can happen. Never waste your time on something like that. Remember, define a clear trend, verify that on the same or lower time frame. Work with swing points to define clearance zones. Use your Fibonacci retraces levels. Let the clearance zone be cleaned. Let the false breakout or fake breakout be validated on the clearance zones. Verify it to be a candle pattern. Any of the candle patterns we described before. Value the risk reward. If it all fits, it's yours. Several tips for you for successful trading. Make sure higher time frame supports your direction. If you want to ride a trend, you do want to make sure there is a room for this trend. There is existence of this trend. And you check it on the higher time frame. So if you trade 4 hour, go to the daily, go to the weekly, make sure you have the room for your trend. It increases your odds. Trading is the business of statistics, probabilities, numbers. Better odds, better performance. Use your knowledge. A lot of traders think that, oh, I only need to know a support or resistance or Fibonacci or trendline or candle pattern to print money. Not correct. The more you know, the more you can verify with, the more you can use to verify your trades, the better your chances would be. Remember me saying trading is all business of statistics, numbers, and probabilities? It fits here as well. Do not trade ranges or not clear trends. A lot of traders spend time on nonsense moves, Trump tweets, some speculations, news numbers, the immediate zigzag up and down. Why? Why? Well, yeah, it's exciting. Will that make you money for the long term? Of course not. It will take it from you. Remember, the clear moves represent clear flow of money into this instrument. If it's not clear, there is no money involved. If there is no money involved, why would there be your money involved? You want to be where there is money involved, where there is a clear structure and better chances to enjoy real movements. You can use any other candle patterns if you know them, or any other technical instruments in your arsenal together with these strategies. And the main thing is the last one, trading journal. Look, most of traders are too lazy. That's the truth. They want to click the buy or sell and make money. Sounds amazing in theory, but there is a reason why most of traders, especially at the beginning of their journey, lose money. This reason is because they don't care of learning from their mistakes. They care about the holy grail. Just give me what makes me money. This indicator, this tool, this strategy, this system, whatever. They don't care about learning from mistakes. If you want to change the statistics in your favor and find yourself on the successful trading statistics, trading journal. Track record your positions, the reasons for your positions. Learn from that. Review that. This way you will know what pairs perform the best for you, what time frames perform the best for you, what kind of trades and setups perform the best for you. If you skip that, It's like shooting in the dark, expecting a good result. Einstein said great sentence once. It's a great quote. Never expect a different result by doing the same thing over and over again. And that's what traders do. They trade with the belief it will be okay. Enter position just because it looks bullish, just because it looks bearish, and so on. Not valuing the risk, not being care of the correctness of the position, of the technical analysis, expecting something good to happen. If you keep doing that, don't be surprised if you will be continuing failing. You want to change the statistics? Treat this as a real business, as expenses and incomes. Track record every single thing, exactly like you track record your incomes, your expenses. You know your budget, you control your budget. How it's different from trading? Why should it be different? It's not. You trade it the same, you would start to see amazing results. Questions? If you guys have any questions, please let me know. Meanwhile, I want to cover the two main questions asked here. Time frames. What's the best time frames for this kind of strategy? My answer is the higher, the better. Meaning, it's not like it will not work on lower time frame. It will. But the lower time frame are much more noisy. Much less money is involved in 1 hour movement rather than a daily movement. Therefore, less reliability. So from my point of view, daily and weekly are the best. 4 hours is great as well. The lower you go, the trickier it becomes. Next, very common question, also asked here. The best instruments. From my point of view, each instrument is wonderful to trade. As long as the moves are clear, are structured, and you respect all the things we spoke about here. Another question, do you need any other technical tools like moving average and so on and so on? So as I said before, use your knowledge. If you have any good tools that work for you, you can definitely combine it with this strategy. The answer is yes. Do you need? No. Will that work together? Yes. And the more you can verify your trade with, the better your chances are. And the questions that keep coming mainly, will this webinar would be available as a recording? The answer is yes. For my followers, it will be sent by emails. For CM Trading followers, it would be sent by them. Okay, or you can contact them and ask for the recording, of course. So I hope that it gave you some extra value. You learned something new and useful for your trading. Joel, do I trade news? The answer is no. Peter, among my projects, the best course, if the course is what you refer to, is the Divergence University. It's the most comprehensive one and covers the very powerful techniques. So guys, thank you very much for being here. I wish you a wonderful evening and wonderful continuation for the week. Thank you for giving me the chance. And once again, I hope it was useful to you. And I wish you best in your trading. And if you have any question to me or to my team, you can find me here, VladimirRibakov.com, or inside my academy in the live trading rooms. Thank you once again. All the best. I'm Vladimir Ribakov. See you soon.